Okay, so today we have our portfolio diversification and risk analysis, um, using the driver framework to build an optimal investment portfolio. So, scenario we're given is we have $10,000 as a signing bonus to invest, and our investment options include TSLA, Tesla, AAPL, JNJ, XOM, BND, and SPY. So each asset has different average returns, volatility, and correlations, and our goal is to create a portfolio that balances risk and return better than the S&P 500 at the end of the day. So our data summary, we have Tesla, average return 35%, with a standard deviation of 60% given to us. Apple, 22%, standard deviation 28%. Johnson & Johnson, average return of 9%, standard deviation of 15%. ExxonMobil, we have return of 8%, standard deviation of 25%. Vanguard Bond ETF with a return of 3%, but a standard deviation of 4%. Then we have the S&P 500 ETF, which has an average return of 12% and a standard deviation of 18%. So some key correlations: Tesla and Apple have a high correlation as they move together. It's kind of like that p-value, if you've ever taken a statistics class, how two of them kind of correlate and coexist with one another. We move over to Johnson & Johnson and ExxonMobil. Have a 0.3, which is moderate to kind of lower end correlation. Tesla and Johnson & Johnson have a negative 0.1 correlation, so a slight negative correlation. The stocks and bonds have a negative 0.20, so an inverse relationship, which is actually a diversification benefit I have noted. And then the low or negative correlations reduce portfolio volatility, so that's a good thing, obviously. So our investment goal is long-term capital growth with moderate risk. Some concerns are obviously high volatility and potential losses during downturn, like when the market's not doing so well. These companies, we want them to be less volatile so they don't go under, just lose all their money. We've already stated our objective. S&P's 12% return while maintaining low risk. So, Tesla offers a high return but is extremely volatile, I have noted. Our bond offers a low return but insanely low risk, so it's just like a very safe bet. You're going to get 4% return with almost zero risk. Then combining uncorrelated assets like Tesla and the bond can reduce like the total risk overall, because you put a lot of money in the bond, so you're definitely making a little bit of money, and then you put the rest of your money in something a little more risky like Tesla. Sprinkle that in a little bit and could be very successful, or if it goes wrong, you'll likely maybe even out, which isn't the worst case scenario. Visualize this relationship in a risk-return scatter plot conceptually. That's kind of a good way to think about it. I wrote down, just thinking about it like with the points that are lower in the x-axis, lower or closer to the x-axis, with like return percentage, and let's pretend return percentage is the y-axis and the standard deviation is the x-axis. We want things to be closer. We want things to be higher on the y-axis, and we want things to be closer to zero on the standard deviation axis. So, yeah. Then we have some example. Example 1, Tesla, return 35%, so high risk, high reward. Example 2, 100% Tesla is just very risky overall. Example 2, we have 6% Tesla, 40% bond. Expected return would be 22%, but it's a little risky. So adding bonds lowers this volatility more than it reduces return. And obviously we want to diversify, we've stated that before. So the S&P 500's return of 12% and the standard deviation of 18%. And the Tesla and bond portfolio we had before had a 22% return, but it's double the risk. So a higher return than the SPY, but still a little more volatile. So a diversified stock mix of remind me, Apple, Johnson & Johnson, ExxonMobil, and the bond may offer a 13 to 15% return with a 14 to 16% risk, depending on how you combine them. So that might be our best course of action, to have maybe, let's say, 30% bonds, 20, 20, and 30. And that might bring us to about a risk-adjusted return, which will give us roughly the same risk, maybe a little less risky, and slightly more return, so slightly better option. So younger investors can tolerate higher equity exposure. That's true. Older investors may shift to 60-40 or 50-50 stock bond mixes. Well, younger investors are going to make more money down the line, so this is true what I noted down. There's a little more risk to younger investors, which they don't have a problem because they see in their future that they have time to make more money. So when you get a bit older, losing all that money at an old age, there's nothing you can really do. I mean, if you're retired, you're not really working, so I don't really know what you would do in that case. So varying these mix changes, risk and return, you want to do that proportionally. And then efficient frontier shows optimal trade-offs between risk and return. So the diversification is kind of like the free lunch, so to speak, as it lowers risk without sacrificing return. And correlation, or the p-values we showed about before, were kind of driving this diversification benefits. So in conclusion, we have an optimal mix for a young investor. 70% diversified equities and 30% bonds. That's what we think for the younger investor. Be good, and a mix of bonds of maybe like the Apple, the Exxons, and the Johnson & Johnsons of the world. And our expected return would be about 14% and risk about 15%, so slightly better in both regards than the S&P 500. And just a last kind of statement, diversification and discipline create sustainable long-term wealth. Then I'll show, this was kind of my driver framework, or kind of how I came about all this information. Now switching over, we have here, where was it? Here we have the equation on how to find our expected, what our respective returns might be. We have this equation right here, where WA is kind of our weight, or our I'd say our what's the word I'm looking for? That's kind of what the current it's the current like amount for whatever the ratio for whatever how much of that stock or bond is going into our portfolio. It's WA, and then the same vice versa for the B. That's the weight, and that goes to all these WA and WB columns. So this could be like Johnson & Johnson, and this could be like Apple, and that's just the percentage, like 0.8, 0.2, but it should equal 1, like we see down here, 0.8, 0.2. Then you have standard deviation of A, so that's the standard deviation we were given for A, and the standard deviation of B. So we use that here and here, and we can plug all these values in. Then we also have this value over here, which is the relationship between the two. Like it shows up here, the stock and bond relationship is -1. So that's what we add there, and we plug all this into our equation like they do for 80% Tesla and 20% bond, 80% 20, 35% standard deviation versus 3% for the bonds. I don't know if they have a full formula. Yep, all these values here, 3%, whatever, whatnot. And then our -0.2 for our probability, and that brings us to expected standard deviation of 47.9% for this sort of combination, which is pretty volatile, not really what we wanted above, but that was more just an example. Now to switch over to our Python code, we have it here, all our different asset data, different weights. This is in the code, the formula we just went over, the function to find the 2 asset portfolio standard deviation risk. Kind of shown dissected more here. This is to find our, this is just listing more data here. This is finding our return. This is helping us. This is using the different outputs of the different portfolio mix-up. This is trying to find our return, like it's SPY's 12% return, and this mix of the different stocks I recommended would be 13.4%, which is greater, so that's what we want. So yeah, I hope this was educational, beneficial, and thank you.